welcome. Hey, folks, thank you so much for taking your Monday night. I know it's National Championship Monday. 7:30 is the game time, so we won't get you too late. We'll be here about maybe 45 minutes. So we appreciate you guys jumping in, spending your evening with us to review the Silvan Townhomes. It's the next offering from Valorous Capital Partners, EFIS, North Star, Alliance Capital Partners. And we are excited to have this 506C accredited investor-only opportunity. So if you know what that means, then you're good to go. All right, so just a couple of disclaimers, right? So obviously, the business plan that we have here is confidential, private information. We do not intend to sell securities of any kind. The information is believed to be reliable, all those kind of good things. There's risk in anything you do. You walk around the street, you get hit by a bus. There's risk in it, right? There's a risk, obviously, in investing into real estate as well. Please know your risks. And what we say in this presentation, we will or may or seek, we're going to expect, we're going to participate or anticipate, project, all these kind of terms, right? That's basically what we're looking at. Financial disclaimer, we are not tax professionals. We are not lawyers or CPAs. So if you have any questions regarding the investment on that front, please go talk to your financial advisors, your CPAs, or your tax professionals. So with that being said, you all disclaimed. We're done with that part now. All right, so let's get into the meat of it. All right, what are we going to do here? We're going to talk about the Silvan Townhomes. We're going to discuss who the team is, right? Why you're investing in not just the property, but you're investing in the team. That's most important, right? Why are you talking to us when you can just go buy stock out there and do it? No, you're talking about the team that's going to be driving this project from start to finish, implementing our business plan, which we will get to in very detail in this presentation. We're going to talk about the investment highlights, the investment overview, market summary, right? So the market overview. Where is this located in Minneapolis, and why we love that town, and why we think it's a great opportunity in this environment. Return summaries, and then the final next steps: what to do to get into the investment. All right, so let's get into the management team here, right? So here's the team in general, right? We got a couple more people on the slides here. You'll see in the next minute. So the main focus I want to talk about is Charlie Peters, right? Charlie is our lead sponsor, right? He's our key personnel. He's our key sponsor, right? So he is the gentleman who's got over 20 years in multifamily experience, right? Multifamily properties, numerous syndications, numerous joint ventures, numerous properties gone through full cycle. Charlie is the man, right? So he's got currently over 2,000 doors, over 100 million under management. And Charlie is just a phenomenal wealth phenomenal guy. He's awesome. We're excited to have him on the team. And then we have our North Lone Star Capital folks. So these are the guys that are living in Minnesota. All right. So we got Gavin and Michael. Both of those folks live right there in Minneapolis. In fact, Michael will tell you a little bit later. He lives in Maple Grove, right across the street from this 48-unit apartment complex. They are our boots on the ground. So Gavin started a construction company, right? And he's been doing this. He's been turning over 300 units a year for other investors or for other operators. And he said, why can't I just do this myself, right? Why can't I just do this for an opportunity and help drive the costs down significantly? So that's what he did. Him and Michael teamed up, and they formed Lone Star Capital, right? So we're very excited to have them on the team as well. Again, they are boots on the ground. They will be doing the turns and all the construction for this property. In fact, crazy story. One time they closed on a previous deal in Rochester, Minnesota. The deal closed on a Friday. That Monday, Gavin was there with all the roofing material and all the roofers to change all the roofs out. And that's how crazy, that's how fast this guy works. So we're very excited for that. And hopefully he can lend some of that experience here onto our team as well. We've got the brains behind the operation, the EFIS Capital folks, right? Who's led by the fearless Caitlin. Caitlin is the one who does all the financials, all the background, she did a due diligence. She was out on the property. She was going through attics and doors, and she was looking at all the plumbing with obviously the due diligence team that we brought on site to do all the stuff on a professional basis. But she runs all that. So we're very excited to have Caitlin helping us out here. And then Bo and Judd. So Bo and Judd both run the investor relations side for EFIS Capital, both a wealth of experience. Judd himself has over 15 years in real estate. This team alone has over 500 doors, almost 500 doors right? And almost $40 million in real estate in just under a couple of years. And they are just getting started. And we're excited to be a part of we're excited to be a part of their team on this in this environment. Then we got Valorous Capital Partners. We got Claudio, myself, your host for the night, and Ritesh. So together we've LP'd and GP'd on numerous deals, over 400 doors ourselves. In LP and GP, we currently own 24 million of assets under management, and we're just going to keep on adding to our portfolio here in the future as well too. But we've got experience everything from short-term rentals to single-family rental portfolios to hard money lending. You name it, we've done it in the real estate business as a collective, and we're excited here as well. And then last but not least, we got Jordan and Kayla Hines, right? So co-founders and managing partners of Next Gen Investment Partners. They are local, again, to the Minnesota area. So I'm sure some of you folks who are on here from Minnesota know Jordan and Kayla. So we're excited to have them on there. They're both very involved in the community and also very involved in the real estate portfolio here as well. So we're excited. So with that being said, I'm going to kick it over to my buddy Bo. Bo, you want to take over and talk about the investment highlights of our Silvan Townhomes?
Absolutely. Thanks, Jeff. Appreciate the introduction there. And as you can see, Maple Grove, Minnesota, I'm going to let Michael talk about it, who obviously lives there, but we're thrilled about this opportunity. It's townhomes and the #1 school district in the state. And as you can see, these townhomes are in really, really good shape compared to other properties we've done. And it's just an amazing opportunity for us and to start the new year, 2024, have an investment opportunity right out of the gates. So it makes that tax planning a lot easier. So just kind of the investment highlights here. This is 48 units. Our purchase price is $10.2 million. We're projecting 16 to 18% annual rate of return. And the total raise that we're raising is just over $4 million. And like Jeff kind of mentions, this is a syndication. And this is split 70-30. So our investors own 70% and us and operators own 30%. And we'll kind of dive into the returns and what that looks like to our investors.
Hey, Bo, before we jump in there, I forgot to mention, guys, do some housekeeping. I forgot to mention you all put your name and jumped in the chat. Well, that's good for saying hi and so forth. But if you have any questions, there's a Q&A function on this Zoom. Just pop your question in the Q&A and we'll be monitoring it and we'll answer it either as it comes or towards the middle or the end. Okay. That was all I got.
Perfect. Thanks, Jeff. So yeah, so this one is a 5 to 7 year hold, looking at 7 years. Our loan terms on it is that we got a 6% agency debt fixed rate. Our budget on it to renovate the units is $400,000. Nice part about this property, after doing more due diligence with our property manager, things like this. So this is a B property, but we're at a B plus, even A minus area, and which in multifamily, they kind of rank those properties A to D, and we would like to buy in that B plus type property in an A minus type area. And that's exactly what we got here with this school district. The place, as Michael dives into a little bit later, but really is an awesome property. And we're occupied at 98%, which is a good sign that shows you how much people are interested in this property and what it has to offer. So we have 2 tiers as far as investing with us. This is class A1. So we have this is a $200,000 minimum investment in your return. So we pay out an annual rate of return of 16 to 18%, like I mentioned earlier, and as well an 8% preferred return that's paid out yearly. And we pay out those each quarter is kind of how the distributions go. This one will start distributions 3rd quarter after close, and funds are due by January 19th. And I'll kind of show you the slide here in just a minute of the full breakdown of that. And the same thing goes with the minimum investment of $100,000. So that's our minimum investment. So anything less than $200,000 is going to be the 16% ARR with a 6% preferred return. Funds are due January 19th, and same thing with the quarterly distributions. They'll be paid 3rd quarter after close. And so as you can see here in this breakdown, this is kind of what it looks like. So if you invested $200,000 or more, you will be receiving each year while we hold this investment, you'll be receiving 8%. So year 1, you'll receive $16,000, year 2, $16,000, all the way through to year 7, right? So the total investment value, if you invested $200,000 by the time we sell this property, is just over $456,000, right? So as you can kind of see the breakdown there, if you follow me on the total preferred returns. So we would have paid you $112,000. We haven't paid you yet because if you look right here on the left-hand side of the page, 18% annually. So that's what we're going to make up to you is that $144,000, and we'll return your capital of that $200,000, which is a total of $450,000. So we're 2.28 equity multiplier, and we'll kind of show you on the next slide here with 100,000, which is a little bit easier to follow me as far as the numbers. So 100,000 is the minimum investment that we're allowing on this deal. So year one, we're going to give out a preferred return of 6% to those that invest 200 less than 200,000. So year two, 6,000 all the way through to year seven. So kind of by the time we sell the property year seven, the investment value would be 214,000. So the total preferred returns we paid you is 42,000. What we haven't paid you yet, going off that 16% ARR, is 72,000. We return that $100,000 in your capital, which would be the final projected returns of basically doubling your money, 214,000, and the equity multiplier on that is just 2.14. And please feel free to ask any questions about that in the chat as we kind of break it down even further. But it is that 16 to 18% each year with that preferred return, which makes it really nice. And for our investors, knowing that one, your investment is in, something in multifamily that has the ability to scale, right? One thing about multifamily, I kind of want to just break down for a minute versus single family is they look at your net operating income to be able to sell your purchase price. So how are we able to tell this? Is by what our purchase price is. And in single family, they look more at the comparisons, right? So in the comparison model, you look at what your neighbor's selling for, that kind of gives you what you can sell it for, versus in this, breaks it down to what our net operating income is how we project those returns.
All right, so the next we're going to talk about is cost segregation and bonus depreciation. So one of the amazing parts of owning real estate is depreciation, right? Is being able to depreciate that asset over a certain amount of period of time. When you have a rental property or a short-term rental, usually your tax professionals or your CPA will depreciate that over a 27.5-year period, right? So you can take a little chunk of everything and just depreciate it slowly over time. Well, what we do with these large commercial properties is we actually perform a cost segregation study. Right? So a cost segregation study allows you to reduce your tax liability and increase cash flows during the time you hold that property, right? So what we're going to do is we're going to have our tax team go through, do this cost segregation study and be able to determine what the size depreciation in year one is, which is much larger. So with a bonus depreciation of up to 60% in 2024, we've estimated this one to be anywhere between 20 to 40% depreciation. Now, what that means is if you take your $100,000 investment, right, and you in 2024, you'll get a K1 from us at the end of the year, right, for the 2024 tax year. You will get a K1 for let's just say a $30,000 paper loss, right? So you're going to be able to use that loss against your earnings and be able to appreciate that off. Now, if you're a real estate professional, or you can use that full amount. So obviously check with your tax professional how that works. But this is one of the most significant things to think about when you're doing this. So yes, you're investing 100 grand, it's a lot of money up front, right? But you're able to get 30 grand of that back in your taxes, or 30% up to 40% back in your taxes at the end of the year. So it's very exciting. But again, talk to your tax professional, your CPA about this. But this is a great, great opportunity to take advantage of.
All right. Thanks, Jeff. Thanks, Bo. I'll talk about here the location. So my name is Michael. I'm with North Lone Star. We are based in the Twin Cities. We're so excited about this deal because of the location. Maple Grove is one of the most desirable suburbs in the Twin Cities. I may be a little bit biased because I live here now, but I do think it's one of the most desirable suburbs in the Twin Cities. For those of you who don't know where Maple Grove is, it's about 25-minute drive northwest of Minneapolis. Has one of the best school systems in the state. As you can see here, high median household income, over 129,000, population just over 70,000 and growing. This suburb has consistent and steady growth. Really nice positive economic trends, really great place to own real estate. My wife and I, we moved here about or earlier this summer. And we moved here because we love what's going on in Maple Grove. We actually live about 10 minutes away from where the property is, so I know the area well. We actually had our firstborn 7 weeks ago at Maple Grove Hospital, and Maple Grove Hospital is about 3 miles away from the property. So yeah, so like with this asset being in such a desirable location, we're going to be able to attract top quality residents. It's right behind an elementary school, very family friendly location. Just overall, very excited about purchasing this asset in this location. Just overall solid market. All right, so apartments in the outer suburbs of the Twin Cities are really highly sought after. There's a lot of competition. It's very hard to find great deals. So on this, we have just some sales comps. So the yellow is these all have an affordable housing component to them. And as you can see, the average price here is a little bit under 200,000 a door. We've got one. It's a 1983 build, 240,000 a door. Ours is a market rate property, 1997 build. We're acquiring this at 213,000 a door. The white is all market rate, so that's a true comp of what our property is, and all of these are well above 200,000, 250, 240, 299, 346. There's one at 200,000, but as you can see, the average price per door is well above 213. So going in, like we feel really confident going in at a solid cost basis for this vintage and location. One little bonus I'll just share here. There was a group trying to buy the property out from under us, and we learned that it was actually the current property management company. So the current property management company, they're a third-party manager, but they also own and operate other assets in the Twin Cities. You know, and that goes to show, like, if the person who has been around and knows the property the best is trying to buy it, you know, it's a good asset. Especially like they were super upset when they found out that we were acquiring it and they weren't able to get it. So let's see. So a little bit more on the overview. Location we already talked about, huge selling point to prospective tenants. We plan to lightly renovate these units upon turnover. I'll touch on that more in a minute. We are going to continue to implement a utility build-back system. Only 65%, or excuse me, 35%. So therefore 65% of tenants are not being billed back for utilities. We plan to continue to implement that and build that back. We're also going to improve our operating expense ratio. Gavin, my business partner, he has a local commercial remodeling company and construction company. So we're going to be able to keep in-house costs low, such as maintenance, contracted services. We can go through a lot of his resources and guys to keep those prices low and in-house. So along with that, we will also be bringing rents to market rate. The current owner is out of Washington State and never really pushed rents to market. They haven't been paying attention real tightly to operating expenses, and they kind of let them go too high. And so with us being local, we'll be able to boost our NOI through increasing our just boots on the ground, making sure that our operating expenses are lower, and at the same time increasing rent and bringing them up to market. All right, leave it on here for just a second. Take a look at these interiors. These are not photoshopped or airbrushed. This is truly what these units look like. There's technically no vintage unit, as every previous owner of this asset has done their version of a renovation. So even the quote unquote vintage units that have old cabinets, they're still less than 10 years old. So we're just coming in and really, for our unit turns, we're just doing light value add. We're just bringing these up to another tier finish. So for example, so these Formica countertops, putting them up, maybe doing a granite. Some of these units putting in more LVP, but nothing crazy. It's already in a really great condition. We're just kind of bringing it up just another tier here. And I'll kind of be brief, but that's exactly what this slide shows. Just kind of countertops, plumbing fixtures, new flooring, wall paint, very simple unit interior turns. Property exterior, brief look at the exteriors. No major exterior CapEx projects needed. We'll mostly just be doing some light value add implementation, which we can see on the next slide. Just adding in grilling stations, pet waste stations, play areas, new signage, no major CapEx issues. We walk every single unit of the entire property. The property is overall in really good shape. All right, so just a brief look at the current rents. I won't go through every single detail here, but feel free, and you guys can reach back out if you wanted us to go through everything real closely. But our 2 beds, we're averaging 1,800. We'll achieve 22,070 after renovations. Our 3 beds are 2,011 currently, and the highest in place 3-bed, as you can see, is 2,395. That's our target rent for our 3 beds after renovation. So we already have proof of concept here that we can achieve this target rent. Rent comps, I won't go into every single comp, but big story is most of our competition are honestly like single family homes and newer construction. So we can fly with this asset under the radar, being a cheaper alternative to these other new, fancy new constructions, but still easily hit our new target rents. So we're in a really, really good position here in a really great market, A-class location, but being able to kind of fly under the radar, being a little bit older vintage to what our neighbors are, as well as us being townhomes, not single family homes. So really, really nice position to be in. And then again, here, won't go line by line, but this is our CapEx breakdown. As you can see, majority of it is just unit turns. And with Gavin and our in-house construction team, like that is huge to be able to have CapEx in-house. Like our previous projects, Jeff mentioned in Rochester, Minnesota, we have really excelled. We've been able to just beat our projections because of our ability to keep costs down, and the time that it takes to get everything done is just so much quicker because there's no middleman. It's us doing the work. And so that we will be able to provide that here in this project as well. So that's a huge benefit to have on the team, and we're super excited and thankful for Gavin and his crew.
Yeah. Hey, Michael, I want to jump in real quick about that, because again, I can't
Sure.
go a presentation without talking. And my love of multifamily properties is the forcing the appreciation, or what we call forced appreciation. Everything that Michael just talked about, right? Providing all of that interior work to upgrade the units with new fixtures, new flooring, all the appliances, all the paint, and then doing a couple of these little outdoor exercises as well. Again, it's a small, light value add at 400 grand, but that will also, what it'll do is it'll force that appreciation faster, right? Sooner, right? Than if we were just to slowly turn them when people move out, right? So we do this fast, we get it done within the first year, and we can then increase our rent. By increasing your rent, we can then increase by increasing the rent and then decreasing the expenses, like Michael mentioned. Also, we get to increase our net operating income, and by doing that, we'll significantly increase the value of properties, not by hundreds of thousands, but by millions of dollars over the lifespan, right? So I'm obsessed with forcing appreciation in properties. I do it in my own personal rentals. I've done it, and obviously with every multifamily business or property we own, we do as well too. So very excited about it, and I think that's a good way to kind of lead into the next thing. So the next is our sources and uses. Right. So if you, again, we'll share this entire presentation so you guys can kind of fine through comb and go through it if you want to, but kind of on the left-hand side shows you our sources, our debt, and our investor equities. Total source is 11 million. And then our uses is all the purchase prices, the cap improvements, act fees, the closing costs, loan points, blah, blah, all that, down to how much that is going to be used of our sources, right? And then obviously a breakdown of what the investor equity is for, and how much that costs. Our total investor equity raises $4,069,000. So that being said, I'm going to go back over to Michael for the market overview.
Awesome. Yes, this is just something I would like to step up and talk about, Jeff, if that's okay with you.
Go for it.
Of course. Yeah, go for it.
Yeah, so the market overview, just a couple of things about Maple Grove, Minnesota, and we've mentioned a lot, and Michael kind of hit on the head, but as you can see here, the 9 out of the 10 residents, including Michael, that live in Maple Grove, and he would know this best, but plan to live there for the next 5 years. It's a community that is thriving with growth, and the people will continue to live and love what the area has to offer. You know, as you can see, the expected growth from 2020 to 2024 is 27% and just continues. Like for us as operators, one thing we looked at, as Jeff talked about forced appreciation, is we also do a lot of research and a lot of data on why we invest in this area, why Maple Grove. And it goes back to, if you look at the last 10 years and the growth that the city has had, it's just been a consistent city that grows and that people love. And that is a big part of, you know, us, where we choose to invest, and why is not only what we can do as operators to bring the rents to market and to renovate the units, but as well, you know, the growth that comes in the city and is expected to in the future years. And kind of with that being said, Minnesota in general is obviously home to some key sports teams, right? We got football, baseball, basketball, hockey, and as well as home to, 15 Fortune 500 companies, right? It's just a community that is really clean, takes care of itself, and it's where people love to live. And that's one of the great part about this in general, is just something that people love to see, is the continued growth. And that's why we have chosen Minnesota, why we've chosen Maple Grove, is because of that, the data behind it, just like Michael talked about, the area that's in. And as you can kind of see here, just kind of where the property is located, around the stores, 5 major highways coming across, just it's in an incredible area. And like I said earlier, this is one of our favorite properties because of that. Awesome. So you can go to the next slide there. This is just kind of going over the return summary here. As you can see, our cash flow year one, just on the left-hand side, it's 102,000. And what we expect year one with the pro forma, our cash flow to be, is 224,000. One thing we do to our investors that separates us, honestly, as operators, is one, we know our investors are our greatest asset. So every single month, we're going to update our investors. What is the expenses? What is the incomes on the property? What's our occupancy at? Because we know that goes a long way. When people invest their hard-earned money, we want to make sure that they know exactly how the property is performing, where it's at, and how we can hit our returns to our investors is that full transparency. And this is kind of the performance showing that. But that breakdown is a big part of what separates us. And as well, why as operators, we pass on a lot of deals. We only do 3 or 4 deals a year. And the reason to that is because we want to underpromise, overdeliver to our investors. We want them to not just come in, invest with us once and move on. We want this to be a continual thing where they continue to invest with us. And as we scale, we grow our wealth together. And this is just kind of more of the breakdown here. And please feel free to, if you want to go in depth with these numbers, we'd be happy to do so. But it is one, you trust us, like Jeff mentioned at the beginning, as operators, but it's 2, the numbers and the deal itself, where we're buying it at with our cap rate at 5.5 rate. We plan to sell it at 6, and we're very conservative. That question we got asked earlier, if we sell it higher than what we predict for, do our investors benefit from it? Yes, absolutely. And that will get shared with you in what's called a PPM, a private placement memorandum. But that breakdown shows you that is our goal, is to underpromise, overdeliver to our investors, because we know that's what's going to continue them to invest with us. And then just our projected returns there on the left-hand side, 18% for 200,000 above, or 16% if it's 100,000 and less than 200,000. And so this is our management track record. Like we mentioned earlier about this, Charlie's been in the business for a long time. We have a lot of units under our belt. And as you kind of see the properties here that we bought, and before, Charlie was in the joint venture a lot, buying these things in cash, and kind of switched over in the last few years to syndication, working with other investors. And it's just been an amazing opportunity to do more deals together. And we have a lot of, units under our belt, and it just goes back to doing the right thing. We only buy the units that are going to benefit our investors best, because it's a long-term play. And as you can see, there's a property right here, Park Hills, Missouri. So this is our 3rd deal that EVIS Capital has done with Charlie and North Lone Star as well. And that property right now, we bought 2 years ago to the date at $16 million. To this date, we could sell it probably about $20, $21 million. And a big part of that is because of our property manager. So the property manager on this, if you want to go to the next slide there, is Alexander Forrest, and they operate and are some of the best in the business to work with. They're all about under promising, over delivering. And as you can see, some of their properties on takeover, what the occupancy is, what it is now. They only take on certain assets. So they are managing thousands of units as well. They only take on certain projects because it has to fit their criteria. And they have a great relationship with us and with Charlie, and we love working with them. And they have, incentives and their average occupancy is over 96%. 60% on renewal rates and 2% or less on delinquencies. And as you can see, that the reason why that is because they do the right things. They communicate to the tenants. They know that the rents are going up, and it goes down to the small things with us. The same thing we do to our investors, they do to the tenants, and that's what allows us to become a powerhouse team and work together so well and be able to continue the occupancy, but also get our rents to market. And it just goes to the communication. So Jeff, I'll turn it back over to you.
Yeah, excellent. Thanks, Bo. I appreciate it. So what are the next steps, right? So how do I get into this investment, right? So we're going to have a couple things. We're after this webinar, you will get an email, right, with the webinar replay link, right? So you'll get a link to this, but you'll also get a number of other links that will take you to our investor portal, right? And so right there, you'll be able to click into that portal, create up and sign up and put in a soft commit. We should have, as Bo mentioned, the PPM, which is a private placement memorandum, which our lawyers are currently drafting. It should be done hopefully today, if not, or hopefully the next day or so, right? Looks like by Wednesday this week, he said. So once those are finalized, they'll be added to there. And then all I got to do is just sign or review those and then subscribe to the private placement. And then from there, you'll get information on how to wire your funds. So as we discussed earlier, we are looking to get this thing fully wrapped up and funded by the 19th at the latest. Property will close on the 25th, but really we want it all funded by that time. And I'm not sure if I mentioned this earlier, but this is a first come, first serve basis, or we like to say first fund, first serve basis. So if you are subscribed, you get your commitment. That's great. But obviously funds that come in first will be first to the table. So and with the amazing cash flow that the property provides and the multiplier, this is going to go fast. So I know personally I am also investing in this deal as well. So I love everything about it, and I'm just excited about the team too, because I'm on the team, but I'm also excited about the team in general. Just to kind of back to the highlights again, minimum investment of $100,000 is a 6% preferred return. Right, so that you'll get that preferred return over starting the third quarter after close, and then you'll have a 16% AAR, which will turn into a 2.14 equity multiplier, earning you a little over $200,000 total investment. With the A1 investment, it's a $200,000 minimum investment. It's a 8% preferred return. Again, same thing. Third quarter is when we start paying those, and this is a 18% AAR with a 2.4 equity multiplier. So your 200 grand will turn into roughly 450,000. So excellent investment. So if you have any questions on the investment, how do I invest, or what other questions we might have, please reach out to your sponsors on the team as well. And if you know Jordan and Kayla, reach out to them also. We just didn't have them on a slide in time. I do apologize about that, but Michael and Josh are from North Star Loan Capital. Judd and Bo over at EFIS, and Ritesh and myself from Valorous Capital Partners. There's our emails, and you'll also get, like I said, you'll get the email, which will have all the information packed in there. So all you gotta do is just click a button, create a profile, and subscribe, and we're off and running. So I think that's it, right? Do we have any other questions?
Yeah, there are a couple questions that I just wanted to answer instead of type. One of them says, on one of the previous slides, it showed the operating expenses increasing over the current operating expenses. I thought you had mentioned with bringing so much work in-house, this would decrease the operating expenses. I'm not sure what slide was shown that showed that, but the current day one going in, so the current, based on the T12, the current, let's see.
What slide was it on? I'll pull it up if you need to.
And I
So,
think one of the
I mean, so our expenses are increasing. However, if you look at the expense ratio, that's kind of the big thing. We're going from close to 50% expense ratio to when we're operating at low 40s, high 30s. So by year 4, we're projecting a 38% expense ratio. So as income is going to be increasing, if it went hand in hand with the way the current owners are managing it, our expenses would be way higher than what they're showing. So our expenses will be a little bit higher. However, it will, it's lower because of our just looking at the expense ratio. I don't know if that makes sense. Did I explain that well? I can hop on a call with somebody if they wanted to go into that with detail. But yes, we are cutting a lot of costs with having everything in house.
Great question. Yeah. And I would just add on to that. So where do we cut costs is with Gavin and North Lone Star being there and his team. And so that is one thing that in our underwriting and stuff, we try and we're very conservative as far as how much it's going to cost versus the actual cost. If you can see that we own 2 other deals in Minnesota, and I'd be happy to show you what our expenses and what we thought our expenses would be versus what our expenses are. And that goes to bringing on Alexander Forrest as well. We pay the premium for the best property manager, in my opinion, in the country. And it goes back to they do the right thing, though, and get our markets to rent that allow us to be able to hit our business plan. And a couple other questions in the pro forma. Can you explain the loss to lease projection from the current? Michael, do you mind explaining on that one?
Yeah, loss to lease. So we have, is that here?
Yeah, it's in the second line there.
Okay, so loss to lease is basically I don't know if you want me to explain loss to lease, but loss to lease is basically the amount of rent that you are below what like total current market rate is. So without renovating anything, just bringing it up to market rate, that's what you're missing out on. So we're going to be capitalizing on that. So before we even swing a hammer, we're going to be offering tenants the ability to stay. However, we just increase rent to market rate. And so I think it was, I don't remember what slide it was. We have our market, I think it's $171 is what that delta is between current rent and what our market rate rent is. So that's what that number is. And then on top of that, there will be another, I think the number is $170 on top of that 171 to get to our total pro forma renovated plus market loss to lease rent. So awesome. Loss to lease is the difference between current rent and what the market rate is without swinging a hammer, basically.
Awesome. Yeah. And then one of the last questions, these are great questions. I love them, by the way. What would be the biggest risk to the projected returns, right? So that is one of the biggest things that we can't, it is an investment, right? So it is no guarantee, but at the same time, the things we do as operators is we're incented by how the property performs, and we pay our investors first. So we pay our investors before we get our returns. And the reason why is because we know we do that, we're going to be incented to do the right thing. And so that way our investors get their returns and then we get paid after. And how many years is years of accelerated depreciation? So kind of the answer to that question is the 27.5 years, we're going to take 60% year 1. So your bonus appreciation that we'll be able to pass out to our investors will be anywhere from 20 to 40% of their investment will be on a K1 we send them in depreciation. And then one of the last ones, do any of you mind walking through worst case scenario with the property and what contingencies you plan for? Michael, do you want to talk about some of the buffers that we have as far as CapEx and kind of explain a little bit more of what that is and how we plan to protect our investors' money?
Yeah, I mean, so just looking at going back to our expense ratio, what we're putting in as far as repairs and maintenance, we've look, especially after raising 400,000 for CapEx, our repairs and maintenance will be able to slim down well below what we have projected, just because a lot of the things that might need to be fixed, would have been fixed through those unit turns. So we feel like we have a good buffer on our repairs and maintenance as well as contract services. with Gavin being in, in the Twin Cities, he's done a lot of work and managed many properties, and done a lot of maintenance for other owners. And so we have a lot of connections with contractors, and our ability to outsource and find contractors at a really good price is another way that we've kind of shown a buffer in our underwriting, as well as our projected rent. So looking, and we don't have like a really good slide in there, and we can, if somebody wanted to walk through exactly what our projected rent is going to be, I'd be happy to hop on another call. But we've had Alexander Force Investment. They also did a analysis for us on our behalf, who's going to be the in-house or the third-party management company on this. They always under promise and over deliver. And so if they're projecting something, we know they're going to achieve that. We're projecting below what they were projecting for us. And so for our 2 beds, they're showing that we should be able to get 2,600, whereas we're showing 2,395. So we already have a pretty large buffer in there. We're trying to show less than what we're actually going to achieve. So I would not be surprised at all. So like currently people are paying 2,395 for the 3 beds. And our projections are based off of us getting to 2,395 by year 3. There's a really good chance, that we're going to be able to achieve higher than that after our renovations and sooner than year 3. So that's probably the biggest buffer we have, is just how long it's going to take to get to our projected pro forma rent versus what we actually can achieve.
So thanks, Michael. Yeah, Jeff, do you want to answer the next question? I get the last one.
Yeah, it looks like there's someone asked a question. What do the numbers look like at the 5-year mark versus 7-year mark? It could be possibly to sell earlier than preferred with preferred returns. Yeah, I mean, in any investment we do, we're always monitoring it annually, right, to see where we are, where the rates are, where the market is, what the cap rates are looking like. We're very much in touch with the professionals, the CoStar data, Marcus and Milchap, all the folks that are got their hands in it as well too, to understand what the market looks like. And if we find an opportunity that we could sell this in 5 years versus 7 years and make the same returns for our investors, yeah, sure, why would we not, right? So there's always a chance for do that, and a lot of times we have seen that in the past, right, where a lot of deals might sell a little bit earlier, right, and then than we initially had in the past, right? So yeah, and then let's see. So Bo, did you want to take that last one, or do you want me to take the last one?
Yeah, you go for it.
All right, gotcha. So what about the potential unfavorable changes in interest rates and or cap rates, and how do they affect the business plan over the 7 years? It's kind of the same thing. I mean, the unfavorable, I don't know if I'm looking at unfavorable interest rates coming up in the next year. I think we've kind of, based on all the economic data I've seen out there, everything that the professionals, all the the gurus are talking about, like, I don't see interest rates going any higher than where they currently are. I think that would, in fact, we're probably in a deep inflationary state right now, or a recession might be coming soon, right? And if that's the case, get your money out of the stock market and put it into a hard asset, right? Even better. But ultimately, the interest rates we see are going to be coming down, right? And in this property, we actually have a fixed rate, so we've got a fixed 7-year term on that rate, right? So we've underwrote for that rate specifically, right? And then we also increased our exit cap rate. We put that a little higher, right? Because we think obviously the cap rates are probably going to compress and come down a little lower in that 4, 5, 6, 7 year time frame. So, for instance, if we sell our deal, which we penciled in, right, at that 6% cap rate, we're going to make money for everybody. We're going to make all of our returns that everybody's asking for. If we are able to sell it at a lower cap rate, right, in the 5.5 range, somewhere around there, it's only going to increase the amount of equity that we'll be able to distribute to our investors. And to kind of go on the question, I think that JB asked earlier, it's not uncapped, right? So I'm sorry, it's not capped, it's uncapped, right? So the more we can make on this deal, right, the more we're going to split 70-30, 70 to all of our investors, 30 to the general partners. after the preferred returns hit, right? So after you get all your 8% preferred returns, then that's when we start paying out our investors money, right? Or sorry, we start paying out our general partnership, and that's a 70-30 split, right? So you as the investor will always have that 70-30 opportunity and the 8% pref in there as well too. So I hope that answers your question. And in fact, I think it's only going to benefit the plan, our business plan moving forward in the future.
Yep. And just to add on to that, kind of like I emphasized earlier, that is the difference of multifamily diving into, the higher our net operating income, our income of the property, the higher we're able to sell it for. And that's where we are very, very conservative in our underwriting with the returns we have. Just for example, we didn't think we would get in our underwriting the interest rate that we got versus, our interest rate, we're thinking it would be above 6, where we're right at 6, maybe right below. And as well, just with our rents being very conservative and in our plan, because for us, it really is about really trying to stay conservative and not to blast numbers, because it is the long-term play. Protecting our investors' money is the number one most important thing to us. And so we know that if we get to where we want to with the net operating income, we'll be able to hit where we want to sell it to in 7 years and having that fixed interest rate.
Excellent. Awesome. Love it. All right. So I don't know if there's any other questions or not. Does anybody have, again, here's our preferred return cycle. Here's the 6% returns. Anybody have any other questions? I don't see any that came in the chat at all, or nothing in the Q&A. I guess we did a good job. I guess we did. Yeah.
Yeah. And feel free to reach out anytime to any of us to answer questions. You want to dive into the underwriting, we'd love to pull it up and show you. And the last thing I will say is our last deal we did get fully funded in soft commitments in 1 week. And so it is a first come, first serve basis. So those who you'll get emailed after this, the way where you can go on and you can create your soft commitment. And what that does, it reserves your spot to be able to invest in this opportunity. We've had a lot of talk already, and just it is a first come, first serve basis. And so please, if you can, get on there and reserve that spot.
Gotcha. And we also have, if you're just ready to go right now, there are a bunch of QR codes here for the 4 companies or four partners on here. We got Lone Star, EFIS, Valoris, and NextGen. So you can scan that QR code, take you right to the investor portal, and sign up and make a soft commit and get that done now. So I guess that concludes the webinar, right? So what would we say, 45 minutes? 52 minutes. Okay. So apologize for the delay in that one, but we'll let you guys get off and go have fun. Watch the national championship if you are. But again, thank you everybody for joining tonight. We really appreciate it. And again, you'll get an email with all this information. So everybody have a great day. We'll see you later.